Welcome to our deep dive on the ultimate HSA timing strategy. If you are currently in a high-deductible health plan and will switch to a non-HDHP, your eligibility to contribute to an HSA ends the moment HDHP coverage ends. Consequently, now is the critical window to contribute and lock in benefits. In this video, we will explain why the HSA is uniquely powerful, how to safely use the invest and reimburse later strategy, how to calculate your remaining contribution limit, and how to move your HSA to a better custodian for lower fees and better investments. Let's begin by previewing what we will cover. Here is our agenda. First, we will explain why timing matters for HSA contributions. Next, we will review the triple tax advantage that makes HSAs uniquely powerful. Then we will detail the invest first strategy and why it can amplify long-term returns. After that, we will show you how to calculate your contribution limit accurately. We will also cover portability, transfers, and how to pick a superior custodian. Finally, we will end with a step-by-step action plan and quick quizzes to confirm your understanding. Now, let's establish why this timing window is so important. HSA eligibility to contribute is tied to your HDHP coverage. Once you no longer have HDHP coverage, you cannot add new money for that period. Therefore, if you are switching to a copay plan next month, your last eligible month is the current one. Funding your HSA now converts taxable income into tax-deductible contributions and preserves the ability for those dollars to grow and be withdrawn tax-free for qualified medical expenses in the future. With the urgency established, let us review why the HSA is so valuable. HSAs are uniquely tax-efficient. First, contributions are generally tax-deductible, lowering your taxable income. Second, any investment earnings can grow without current taxation. Third, when you withdraw funds for qualified medical expenses, those withdrawals are tax-free. Critically, once you get money into an HSA, its tax advantage status remains even if you later switch away from an HDHP. In other words, the account can remain invested and continue compounding tax-free, and you can still use it for qualified expenses in the future. With these advantages in mind, let us introduce the invest-first strategy that many long-term planners favor. This content is educational and not individualized tax, legal, or investment advice. Always verify specifics through IRS resources, such as Publication 969, or with a qualified professional. Contribution limits, definitions, and rules can change. Your personal circumstances, including other coverage, Medicare enrollment, or spouse's coverage, may affect eligibility. With that in mind, let us move on to the strategy. Rather than using the HSA for every minor medical bill, treat it like a long-term investment vehicle. Pay for small expenses out of pocket so that your HSA dollars remain invested and compounding. Keep meticulous records of every qualified expense you paid with non-HSA dollars. In the future, even decades from now, you can reimburse yourself tax-free for those accumulated past expenses as long as they were incurred after your HSA was established and you have adequate documentation. This approach effectively turns the HSA into a flexible, tax-free reserve for future needs. Next, to make this work smoothly, you will want an airtight receipt system. Implement a repeatable documentation process. First, scan each receipt as soon as you receive it and save it as a PDF or high-quality image. Use consistent file naming, such as date, provider, and amount. Organize the files by year with subfolders by provider. Maintain a spreadsheet that lists the date, provider, purpose, amount, whether it was paid from your HSA or out of pocket, and a link to the stored file. Remember that you cannot both reimburse from your HSA and claim the same expense as an itemized deduction. Now that your documentation is in order, let us move into the actionable steps to take before eligibility ends. Here is your step-by-step plan. First, verify precisely when your HDHP coverage ends and identify your last eligible month. Second, add up all contributions made so far this year, including employer contributions, to understand your remaining room. Third, compute your allowable contribution using the monthly eligibility prorating method or, if applicable, the last month rule. Fourth, if considering the last month rule, evaluate the testing period requirement through the end of the following year and the risk of income inclusion and penalty if you do not remain eligible. Fifth, Contribute the remaining amount before your window closes. 6th, invest promptly based on your risk tolerance and time horizon, and avoid custodians that force large idle cash balances. 7th, if your current provider has high fees or poor investment options, consider moving to a custodian with lower costs and better funds. 8th, initiate a trustee-to-trustee transfer to minimize friction. Finally, implement your receipt tracking system so you can reimburse yourself later as needed. With the plan in place, let us define how to calculate your contribution limit precisely. To compute your limit, count the number of months in the tax year during which you were HSA eligible. Multiply the annual IRS limit by the fraction of eligible months over 12. If you are age 55 or older, also prorate the catch-up amount by eligible months. Alternatively, under the last month rule, if you are eligible on December 1st, you may contribute as if you were eligible for the entire year. However, this requires you to remain eligible through the end of the following year, known as the testing period. If you fail the testing period, the amount attributable to months you are not actually eligible becomes taxable income and may be subject to a penalty. Finally, remember that you can make contributions for a tax year up until the tax filing deadline for that year, but always verify the exact deadline for the current year. Next, let us visualize a typical timeline if you are switching plans. This timeline illustrates the months you are HSA eligible, the month your plan switches, and the contribution window up to the tax filing deadline. It also shows how the last month rule hinges on being eligible on December 1st and then remaining eligible through the end of the following year. If you meet that full testing period, the full year contribution is preserved. If you fail it, the portion attributable to ineligible months can become taxable with a penalty. With the timeline in mind, let us compare HSAs with accounts that are often confused with them. On the left, HSAs are individually owned, portable, and funds roll over indefinitely. Contributions require HDHP eligibility, and the account can be invested for long-term growth with the triple tax advantage for qualified expenses. On the right, FSAs and HRAs are employer arrangements with plan-specific rules, often not portable when you leave employment. They commonly have use it or lose it or limited carryover provisions and typically do not provide investment options. Their tax and reimbursement rules differ significantly from HSAs. Understanding these differences helps you avoid mistakes when planning contributions and reimbursements. Now, let us focus on how to choose a custodian that supports long-term growth. Use this checklist when evaluating HSA custodians. Prioritize providers with zero or minimal administrative fees, low or no cash minimums to access investment funds, and broad, low-cost index options. Automatic investment features help keep idle cash low. Look for straightforward trustee-to-trustee transfers and minimal transfer or closing fees. Finally, good tools, clear statements, and accessible tax forms simplify your annual filings and long-term record keeping. With a custodian chosen, let us examine how portability actually works. You can move your HSA via a trustee-to-trustee transfer, which is a direct movement of funds between custodians and is not subject to the 1 per 12-month limit. Alternatively, a rollover gives the funds to you first, and you must redeposit within 60 days. Rollovers are restricted to once every 12 months. Regardless of how it is funded or where you work, your HSA belongs to you. When selecting or switching custodians, avoid high mandatory cash balances and recurring administrative fees that can undermine long-term growth. With the mechanics in place, let us test your understanding with a quick quiz. Quiz time. The question is, if you use the last month rule to contribute the full year amount, what must happen to avoid tax and penalty on the extra amount? Option A. You must remain HSA eligible through the end of the following calendar year. Option B. You only need to be eligible until the end of the current year. Option C. You must keep receipts for at least 1 year. Option D. Your employer must continue contributing to your HSA. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is that you must remain HSA eligible through the end of the following calendar year. This is the testing period. If you fail the testing period, the portion of the contribution attributable to months you are not actually eligible becomes taxable income and may be subject to a penalty. Now, let us move to one more quick quiz. Second quiz. The question is, when can you reimburse yourself from an HSA for a qualified medical expense paid out of pocket? Option A. Anytime in the future. if the expense was incurred after the HSA was established and you kept proper documentation. Option B, only within the same tax year as the expense. Option C, only within 60 days of the expense. Option D, only if you also itemize deductions for medical expenses. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is that you can reimburse yourself at any time in the future, provided the expense was incurred after the HSA was established and you retain proper documentation. There is no requirement to do it in the same year, and it is not limited to 60 days. Additionally, you should not claim an itemized deduction for an expense that you later reimburse from your HSA. With the quizzes complete, let us cement the key takeaways. Here are the key points. First, HSA contribution eligibility stops as soon as HDHP coverage ends. Second, the HSA's triple tax advantage makes it especially powerful for long-term planning. Third, the Invest First strategy can maximize compounding if you pay smaller bills out of pocket and maintain meticulous documentation. Fourth, calculate contribution limits correctly and be cautious with the last month rule and its testing period. Finally, your HSA is yours and portable, so consider transferring to a low-fee custodian with strong investment options. Next, let us summarize and set your next steps. In summary, confirm your final month of HSA eligibility and contribute before the window closes. Choose the calculation method that fits your situation, considering the last month rule only if you are confident about the testing period. If your current provider is costly or restrictive, transfer to a better custodian and invest for long-term growth. Put your receipt protocol in place so you can reimburse yourself tax-free in the future. For specifics, consult IRS resources such as Publication 969 or speak with a qualified professional. Finally, here is a quick closing note. Thank you for watching. If you found this valuable, please like the video, share it with someone who is changing health plans, and subscribe for more practical, tax-smart strategies. I would love to hear your questions and your HSA experiences in the comments. What custodians do you like, and how are you documenting receipts? See you in the next video.